Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast. With me, I have Nick Fusco, CEO of PM Insights. It's a pre-IPO stock secondary market pricing company, and Evan Cohen, founder and chief operating officer with Vincent.com. It's a media company focused on alternative investments. I'm Aaron Dillon, and at AG Dillon & Co., we do venture capital funds for RIAs. All right, fellas, the only thing to talk about is tariffs. So, the market is down. It's Monday. We record this Monday, like 3 o'clock Eastern time. The market's down like 75 basis points for the S&P, 0.5% for NASDAQ. It's been rough. Doesn't look like we're going to be moving off of these tariffs. They're committed, right? So as kind of discussed over the weekend and before the call here, my hope is that we could focus on the opportunities that persist with the tariffs, right? But perhaps, Nick, we could start you off first. Like, what are your thoughts on these tariffs, how they kind of impact pre-IPO stock, and any general thoughts about the tariffs at the onset?
Sure. Well, we always like to put the slant of the private markets in this podcast, right? It's This Week in Pre-IPO Stocks. So on social, I have seen quite a few people really hyping up the private markets. Look, we can hide from the volatility. We can hide from the slaughterhouse that is the public markets right now. Do I think that's accurate? I'm gonna say no. We're starting to see. I mean, half the reason why our service exists is to manage risk, keep track of valuations, look at those declines. I think we are seeing already that there are going to be some declines. Some stocks are coming off. Some valuations are popping, which we'll hit later, like OpenAI and things like that. But they're probably going to be more muted. You're not seeing as much volatility. Everyone does have a much more longer dated view in the private market, but you're getting the concerns. So one thing that we're kind of anticipating here is the private companies are going to act, in their best interest to cut costs. So how are they going to do that? They can do that through AI. They can do that through headcount. I know that certain firms have already laid off. And then also, I mean, you're going to have to look your best to get financing, and financing in the private market is getting much more pervasive across different kind of GP and LP sets. So I think we're getting a stronger set of private companies now. We may not see as many IPOs, coming up after a lot of what kicked off that seemed like a bit of a big surprise. But I think we have to weather the storm with a very long dated view of how these private companies are performing. And then even at our own, given we're private, we're starting to get hurt a little bit too. I mean, we're looking at even FX rates change. Even if we're not importing anything because we're a SaaS company or a data company, we have foreign employees and they just got 5 cents more expensive on a per pound basis, let's say, for some of those abroad there. There's a lot to take into account. So I think whether you're public or private, you're going to put your risk hat on to account for it.
Right. Evan, what do you think? Tariffs, man. Where's your head at?
Man, where to begin? So I think for the topics that we talk about here in the private markets, I agree with what Nick said. Look, anyone investing in venture generally should have a long dated view. Now, I know we've talked about it here before. It's like when you're investing in late stage pre-IPO, like your exit window is a little bit different than you're doing early stage, but you're sort of taking the concept of like, oh, liquidity is a feature, not a pain. It's like I think this is one of those moments where, hey, if you're holding private assets and you don't have to watch the volatility in your portfolio every day, it could be a good thing. But I do think if you're a business owner, it's definitely much more challenging to forecast how the world is going to operate in 24 to 36 months, which is really how venture capital startups and companies really think, right?
Right.
When you're investing in venture capital, you typically are investing in companies that are not profitable. They are long dated. They're aiming for, big wins, big investments, big outcomes. And when you have uncertainty, especially if you're selling a global product and you have uncertainty like this, it really does make you rethink, hey, like, what's our go-to-market? How is this going to impact our customers? How is this going to impact our employees? And that uncertainty is not good for operators, and ultimately that trickles down to investors. There are some benefits, I think, for the pre-IPO market that's a little bit different than public. Like, for one, again, like we generally invest in companies that are not profitable. Profit expectations are not things that pre-IPO companies like are generally hyper focused on. Now it's always great to invest in one that's profitable, but again, this is big swings, home run bets. You're not looking for singles and doubles. So being in the private markets and betting on those long dated outcomes could be a good thing.
Right.
And also in the venture capital market, they tend to do funding in 12 to 24 month cycles, right? When you're a founder and you're fundraising, Nick and I have done this before. It's like the investor asks, well, how long is this funding going to keep you operational? And you generally say, 2 to 3 years, 24, 36 months, sometimes 12 months, but it's not really recommended. And so ideally, a lot of these companies, they raised capital in the last 12 months and they have a war chest where they can continue to be heads down, not let the macro impact their growth, and use the cash that they have to operate efficiently. And so I think that does bear well for some investors. But yeah, I think that the general fiscal policy around the tariffs is just, the uncertainty is really where it's going to all unravel, in my opinion.
Okay. Yeah, I mean, look, I think this uncertainty, certainly, I don't think a lot of these pre-IPO stocks are going to be going public anytime soon, right? I think they were already on the fence. Like Evan, you mentioned before we hit record here that Klarna's, threw up the stop sign. It looks like they've paused. I think others that were probably thinking about going in summer or second half of the year, they're probably off the table now too. Like there's just going to be a lot of disruption here over probably the next 12 months. So I can't see this IPO window getting thrown wide open and a whole bunch of people coming public, right? If they, if Donald Trump comes out and says something and then all of a sudden we have a market rout and that's the week that you're slated to go public, that's a tough go of it, right? So I think you're going to see more, I think this trend of companies staying private for longer is going to persist, which I think is ultimately, good for guys like us or good for people who want to participate in that market. But look, I got to tell you, this, when I see things like this happen, where there's major market disruptions, and maybe I'm aging myself a little bit here, right? But I'm 20 years on Wall Street, so I've seen a few things. To me, this is an incredible buying opportunity, right? Might not feel like it, but this is where things can get, attractive, and you can step in to buy. I think, Nick, you mentioned, there's maybe less volatility. So I'm super intrigued to see where prices go, in the secondary market. The primary market, they'll probably just seize up. There'll just be not a lot of activity happening, here over the next couple months as this stuff probably shakes out. But it'd be really interesting to see if the secondary market prices come down and what that means.
Never waste a good panic is where you're headed, right?
I don't know if it's panic, but it's just look, if NASDAQ just sold off by whatever it was, X
15%, 20%.
Yeah, right. But then who knows where it's going, right? You know what I'm saying, Evan? So if it keeps going, it gets worse. Does that translate into the private secondary market?
Even if it does, I mean, the correlation isn't quite the same, right? So you're never going to use public stocks to value private stocks.
Mm-hmm.
Maybe that's helpful, to a certain extent, but yeah, you're going to have a more diversified portfolio if you're able to touch commodities, if you're able to touch privates, if you're able to touch, that sounded bad, touching privates. Yeah, backtrack that. But you want to have your fixed income, you want to have a bit of diversity in there so that you can withstand some of these shocks, whether they're on one end of the market or the other. But additionally, if you actually look at some of these names, they are the most well-positioned companies out there,
right?
In an extremely challenging environment or a changing environment, right? So if you look at those that can scale up and scale down on headcount relatively efficiently, if you're looking at those that have the best infrastructure in terms of the most up-to-date software, hardware, whatever sort of setup that they need, these newest companies, Klarna included, would be in that ilk. So, yeah.
Let me ask you though. So, because this is, I think that one of the topics that sort of gets brushed away when they're talking about tariffs on CNBC is the concept of protectionism and how Like when you evaluate a company, especially a pre-IPO company, like startups, we always think of global domination, right? Like you start in one market, you start in the US, then you expand globally. You look at Uber, you look at Shopify, all these things, all these companies that are very successful. And I wonder if the administration is really focused on protectionism, does that force you to reevaluate the TAM on some of these companies? For example, because look, Klarna is a great example, right? I think that they've probably grown to their maturity in their local geography in Europe, and they're obviously expanding in the United States, and they have a global presence. But I wonder how much more TAM they could have in a world where these countries are putting up walls and saying, hey, we don't want to work with an international company. We want our local version of that.
Right.
Especially in the US is sort of leading that, which is shocking and scary in my opinion. But yeah, does it force both of you guys to reevaluate, well, what is the TAM of this company in a protectionist market? And then therefore, how does that trickle down to the valuation?
Yeah, but you got to look at that. I mean, one thing comes to mind where the longer standing 100-year-old company with a bit of a pedigree and a brand name, there's going to be some lasting staying power in there. But a big global conglomerate or something like a GE is probably going to get beat up a little bit harder than the next reincarnation of someone that competes with one of their many, many business lines is my thought. And then still the US market, you look at the number of growth stocks that are out there, growth stage private, pre-IPO, which we probably shouldn't call it anymore, right? You've got so many, a proliferation of them all being US based. And then we are the biggest market out there in terms of where you want to sell product. Like even we were talking about Formula One with a buddy over the weekend. We are the biggest audience of Formula One. When you think of America, you don't think you're like F1 racing. That's not the first thing that comes to mind. But we are the biggest audience. And I think the fact that most of these unicorns that we focus on are born or growing in the US, they're going to be able to compete with the pre-existing US-based counterparts that they have. And again, a lot of them are very, very focused, on one or a couple business lines rather than doing, the Swiss Army knife approach. And that's probably a safer bet too. You get to really pick what's going to work and what won't in the future. So yeah, I think it will hurt everybody, Evan, to answer the question, but it will hurt everybody. Right.
Yeah.
So some worse than others is what you're saying.
Yeah. I think we're going to be able to navigate it from our end of the market better than those long-standing public or private companies.
I don't see this in the long run holding. Like I think there's a lot of negotiating happening right now. So I think it'd be interesting to see
3 years, 9 months type holds?
Yeah, there's that, right? Like new government in the US and then like what happens, because as easy as these things come on, they can come off. Like the thing that will be staying is if, manufacturing also like actually onshores, right? Because it's hard, I think, to move away from a facility that you've paid CapEx into and everything to build, right? If you're one of these international companies or a domestic company that's bringing back manufacturing back home. So, like that stuff I think has staying power. But I mean, if that can't be done efficiently, then probably as soon as you get a new government and this stuff goes away, you shoot it right back out to the foreign country. So like this wasn't a law that was passed. It was an executive order done under Emergency Act. So like as soon as either of these things come in, they can come out. So I don't know if like the US as a country has strong opinions about protectionism, right? I just think that's like what's happening right now. So it'd be interesting to see if this persists over the duration. That's why I think this is like a buying opportunity. Like there's going to be there's like disruption. It's obvious. It's happened, right? So like how long will this persist? And then what opportunities does that create? And since we're all like pre-IPO stock guys, what opportunities does that create in the pre-IPO stock asset class that you can take advantage of, right? So if it's just a wholesale pullback on the market, then, that's something interesting to take a look at. Is it some of this like onshoring or cost cutting? Like you brought up, Evan, Klarna and some of these other companies like that. That's where I actually think some of these pre-IPO stocks could benefit. Right. So just to call out like a few, I actually think robotics could stand to benefit dramatically in this type of an environment. So like if I'm a CEO of a company and I'm manufacturing in Vietnam, and let's say they can't come to terms, so I got to bring my plant, I have a decision to make. I can either pay this tariff, or in China, maybe China's an easier one because that one's going nuts today, right? Looks like we're doing 50% more tomorrow, right? So like China and the US have this big falling out. I have a factory in China that I'm making my widget, and now I have to decide, do I pay this really, really high tariff, or do I bring this to a different country that maybe has a lower tariff that I can stomach, or do I bring it back to the US where there's no tariff? And how much more cost am I willing to digest? I could either go back to everybody on my team and say, hey, we got to start using this AI stuff now. We don't have a choice. So like start getting rid of the accountants, start getting rid of the lawyers. Like we got to adopt this stuff fast because we got to cut costs because we got to eat some of this tariff expense that's coming through. Or do I say, hey, I'm going to start to, maybe can I match what we're doing in this foreign market using technology, using robotics, which I don't know. I think it's still too early, right, to answer that question. But maybe in a year or two, it's a viable option, right? What are your guys' thoughts? Like, what are your guys' thoughts on just opportunities and kind of onshoring manufacturing? Any strong feelings about that?
I mean, I find it very challenging for us to compete on the labor side and on the materials side with China when it comes to manufacturing. And my belief is that, even if we brought back the manufacturing of many different products here in the United States, I don't think people want to work those jobs.
Like I don't think you want to. Dave Chappelle said it best. I want to wear Nikes. I don't want to make them.
Yeah. And so I think it's a little bit of a, it's a fallacy, sort of, this thing that onshoring is going to result in the way it's just going to result in more expensive products. I don't think that we have the manufacturing capability here to be as efficient, as cost efficient, and produces high quality products. So I don't know if it's at the end of the day a good thing for us. I do think that it's interesting from like if you're the people building if you're building the robotics or the robots that are going to be doing some of this manufacturing, that's compelling, but it sort of begs the question, though, that would the administration just try to stop that, right? Like if they're willing to put up tariffs to protect American jobs and worker jobs, what's stopping them from putting up rules that say that you can't have robots in the factories? Like,
it's a good question.
It wouldn't surprise me.
But that's a natural evolution. I think that's a much safer bet, and that's not going to happen for another few years. If you look at an Amazon plant, how much of that is actually some woman or man packing boxes? There's so much automation that takes place. So this is just the next reincarnation of that to a certain extent. And the fact that, the manufacturing for that, right, creating robots, is probably not that different than what we thought was for EV 15 years ago. If we had some of this protectionism back then, maybe we would be doing, I don't know, even more for EV. And now we're kind of losing ground on that. You look at some of the non-Tesla international automakers, even though we're going to stop importing even more. I think Land Rover and Jaguar said they're not going to import to the U.S. right now. Yes. Maybe that headline's been pulled. We'll see.
Yeah.
But yeah, since we're so early in the robotics play, that I could see that coming domestically. That'd be a fair shake.
Well, you talk about adoption, like with robotics in particular. Right. I mean, you got Figure AI, 1X Technologies, right? There's several other, right, that are interesting. I think U.S. robotic companies. I mean, there's also foreign robotics companies, I suppose, that you could buy their robots and bring them here and use those. But the fastest force in nature that I've ever seen is an income statement, right? So if all of a sudden, like, it makes sense to do that, people are going to give it a shot.
But remember, like, that logic it makes so much sense when you're thinking logically or rationally. But these tariffs are not rational, and that is the problem.
Well, that's another problem. That's another problem altogether, right? So then that kind of begs the question. It's like, and this, I don't want to get into how it was rolled out. I thought how it was rolled out is just not well done. But like that's another 5-hour long discussion we can have over a beer or something. But it's clear that this is not going to be, there's going to be a lot of moving parts here for the next couple of months, right? So to your point, Evan, like when do things kind of settle in where then you can, as a CEO of a company, operator of a company, you can start to implement some of things because you know things are going to be set for, a year, 2 years, 3 years. If you're doing manufacturing, you got to have things like locked in so that you can make decisions, right?
Exactly. That's where the market hates surprises, right? So we've seen that clearly. The way this was rolled out, the market hated the surprise of it just as much as the act itself. And if we don't know if it's going to be pulled back or reversed a little bit or anything like that, as a manufacturer, you're going to be pretty hard pressed to bring it back, Yeah.
Well, you could also offer though that, I mean, there's one argument to make, I suppose, like lowest common denominator. Like, look, we're growing and I need more manufacturing facilities. So like we might as well just build it here.
Domestically.
Yeah. Like if we know that there's a 60% chance there's going to be some kind of tariff now, I got to like calculate that in and make my best estimate on what that is and do the math and see if like, do we do it here in the US or do we do it internationally? And if we do it in the US, do I use robotics? Do I use people? Like, how do we do that? You know what I mean? What state do I do it in? I mean, there's a lot of decisions to make, I guess. Tax rebates, all of that stuff would probably come into play. But yeah, that's one area I have my eye on is if we are in fact onshoring manufacturing, I have to imagine that's going to be good for robotics, right? But to Evan's point, I think there's a lot of things that have to happen before we get from here to there. I'm kind of what I got my eye on is how quickly those things happen, right?
Right. If you think the cost of an iPhone is going to go up extortionately, how much do you think a robot produced here is going to cost, right?
Yeah.
So that's a problem.
And I just go back to the intention of the administration, which in my view, it seems very clear that they're not really acting rationally in sense of the markets. They're really optimizing for the worker.
Yeah.
Like the optimize for the worker. And like, let's look, what did Trump do for the longshoremen on the Eastern Seaboard? He negotiated a deal which gave them all pretty significant pay raises and put in a rule that said that they couldn't have automation.
It's a good point.
What does that? Yeah. So like, again, if he's sitting here focused on bringing the American industrialization workforce back, manufacturing back, he wants human labor. He's not looking for he's not doing this for a robotics play. And so I just find it really hard to get, if I was a CEO, to be comfortable in investing in that, knowing that you could spend a couple million to 50 million, 100 million on manufacturing, building an automation manufacturing facility. And then Trump could sit there and say, well, here's the new rule. 80% of your products have to be human touched. And then you're screwed.
It's empty.
And you can't really plan for that.
Yeah.
Where we sit today without the clarity. And so I think that all of this, the uncertainty and just trying to read the objectives of the administration does not paint a pretty picture for anyone trying to do big business. I think it's great for small business and medium-sized businesses.
Right. Okay, let's talk about this real quick. So on kind of the same thoughts, if costs to create goods and services are going to go up, arguably executive teams are going to try and find ways to cut costs in other areas, right? To still maintain and drive margin. So that, I would think, again, would be a major driver of adoption of AI, right? And more perhaps white collar jobs. Like Evan, any thoughts on Klarna is a good example. I know we talked about them earlier about going public, but they're a good example of a company that like massively adopted AI and it had a very positive impact on their net income, right, and their expenses. Do you see more companies using like an OpenAI, an Anthropic, an XAI, et cetera, to try to like offset some of the increased costs for their inputs and their products?
Absolutely. When the market crashed in 22, we saw it in the venture stage, the earlier stage companies. It was all about cost efficiency, right? How can you trim your fat, get efficient, spend effectively, and AI is one of the ultimate tools for that. I mean, I think Shopify announced today that they're not expanding headcount unless the person who requests the headcount can prove that the headcount that they need, that AI could not do the work, the incremental work or effort required to hire an additional person.
Right.
That makes complete sense to me.
Yeah.
And I think that AI will be the sort of tool that will replace a lot of white collar jobs, replace a lot of workers, and make companies much more efficient. And so if you think of it with that lens on, I do think it's a great buying opportunity for some companies that can become more efficient in a market like this.
Right.
And, when you see things like this happen, like it also kind of creates a really easy scapegoat for executives to say, well, look, we have to do a riff. Why? Look, the markets are down. Our market comps are down. Our competitors are down.
Things get tight.
And it's kind of like an easy backdoor. Like you can rationalize it for yourself versus when the markets are super hot. Like it's really hard to justify that, and you get a lot of flack for it.
Besson said that, Treasury Secretary said that this past weekend. It's like, it's not just going to all come from, it's not going to just be straight to the consumer. Like to your point, Evan, like some of the costs will come from the operations, some will get eaten by the suppliers, and then some, a little bit will get passed on to the customers. So, I mean, but Nick, do you agree? Like, or what are your thoughts on does this help accelerate AI adoption?
Absolutely. Right? Yeah. So my answer is just yes, full stop. But I'll throw another question out there because it always gets me thinking. I think the newer companies that have all been formed in the last 5 or 10 years really are much more efficient, adaptable, can onboard this technology much faster. They're ready to go. Klarna was always our base case for this, right?
Mm-hmm.
What about which companies stand the most to gain from it, though? Maybe these are the 50 or 60 or 70-year-old companies that have not been at the front of adoption. They've got staff that actually really could clearly be automated away, but it's going to be harder to get, X, Y, and Z heads from HR, X, Y, and Z heads from accounting out. So where do we think? Do we think, those names that are brand names are going to be nice buys here because that over the long haul they can be automated, or is it the names that are just like low-hanging fruit?
No, but though, to your point though, Nick, like usually I think at least the big companies that I've worked at or been heavily involved with, they don't riff those people or let go of those people for like internal politics reasons. You know what I mean?
You're talking about like the 5-6% cull per year type idea, or
just to like Evan's point, like now this is a reason why they can do it. You were kind of alluding to that too. Like this is happening now. Tariffs happen. Like, oof, we can't raise prices for customers, guys. So we got to get rid of 15% of our staff, or maybe like in other periods without AI, that would have been a 5 to 7% layoff, and now it could be something closer to like 15%, or maybe even 20. I don't want to get cheeky about it, right? But like, you know what I mean? Like it could be something higher than what it was historically because you have, AI, the AI opportunity now.
Right. So the question also begs though, Shopify, you put this in the headline, and I don't think anyone's going to freak out. They're going to say, "Oh, this makes sense." Like Shopify can handle that. But what if it was an older company that was in the same vertical?
Oh yeah, that's definitely, if you're an analyst, that's something to get excited
Target
about.
Target or Walmart, right?
For sure. Like
and
that's
great.
Something to get excited about.
Those companies are run so well, right?
Right.
But they don't have high margin, and they're not high margin businesses because they've been around for a long time. And when you don't have a lot of margin to play with, and tariffs come to play, it gets real tight real fast.
Yeah, it's a fair point.
You look at these technology companies; they just have substantially more margin generally to play with if obviously company dependent. And so I think you'll see a company like Shopify who's probably making 50-60% margins, being like, we can weather the storm, we have cash in the bank, and we can get more efficient. But I don't know if Target or Walmart or Home Depot has the ability to,
as a company, you're saying they don't have the chops.
I mean,
this is creative destruction. This is literally the definition of creative destruction, right? Like some of these people won't be able to figure it out, and other executive teams will, and the ones that do win, and they eat the ones that didn't. I mean,
so sorry to belabor this point, but right, and you're looking at Home Depot, you're looking at Costco, you're looking at these big names that benefit from driving the cost down as much as possible for the end consumer. And I forget if it was Aaron or Evan that was saying, the small and medium size will actually do okay. They can weather the storm. In this case, I don't know. Try competing with Costco on price. You're going to get fried. That's
the
real hard.
Goods product. Yeah.
I don't disagree.
Yeah. This is just like, but this is where we talk about opportunities. Like, so this is an opportunity. And if you look at the pre-IPO stock, like the top 10, 20, 30 stocks, like there's a lot of AI stocks in there we've been talking about AI apps coming down the pipe for several weeks now. I think this is a huge opportunity for AI apps. If you come up with an AI accountant agent, right, that can do X, then a lot of companies that probably wouldn't have been looking at that are now going to be looking at it because it's going to be a fraction of the cost of a human, right? So I think this is it's like an accelerator, right? Because of this major market disruption to AI adoption, which I think is going to be like super interesting for this asset class, right? So that's kind of another thing that I've been having my eye on. Go ahead.
Just thinking about, so one thing I like when I think about this protectionist perspective from the administration, one thing I worry about is that, the brand of the United States. Actually, let me preface this. I spent 3 years working in venture capital in Europe, and I saw the way that the Europeans and the EU looked at the American and entrepreneurial system. And there was a lot of admiration, a lot of like, hey, the US has the best entrepreneurs, they have the most ambition, they think the biggest, and they execute the best. And it was like, and generally it was, there was a lot of envy for the EU investors trying to get exposure to that. I think in a world where protectionism happens, there's a risk that, those investors might sit there and say, well, I'd rather invest in a European company that might have less tariffs with a global economy, right? Like there's less risk there. They want to do business with us. They can reach different customers. They might be able to manufacture with China without the high expenses of tariffs, things like that. And I do wonder from the software and the hardware side, does it create a massive risk for American-based companies who, that reputation gets tarnished, and you wonder what that differentiator is. The being American, the American passport has really always been the thing that gives us so much power. If you lose that, or it loses its tarnish, like then what separates us? Technology, engineering, and then with AI, it sort of levels the playing field. You're like, well, do you really need the best engineers? Like, there's amazing engineers in Serbia and Croatia and Lithuania, and the reason why they just haven't been able to tackle the markets is because the US's market is so big. Sort of what Nick was saying, like everyone wants to sell to us. But if the administration makes it very clear that like we only want Americans to buy American products, then like the EU is gonna be like, well, like, we'll just take the rest of the world or China or someone else. Like it makes you wonder, like, well, would you want to use OpenAI or would you want to use DeepSeek? I don't know. Like,
fair point.
Creates a question there.
Yeah, I mean that's certainly something to keep an eye on.
Or Mistral. Mistral's a great example, like open source, French-based AI. Like as these models get commoditized, like I can see all those EU companies that were excited to build on Claude or OpenAI might just be like, well, you know what, tariffs, like this is kind of annoying. Like I'll just deal with Mistral, my local EU-based one. Like, and then look, then you just sort of hamstring all of those American companies that want to go big or go home.
Yeah. I mean, you're definitely going to have to, if you're a U.S. company, you're going to have to deliver like better results and a better quality product, probably even more so than you had in the past if you want international customers, right? Because you got to make up for the tariff too, right? So
exactly.
You got to make up for the tariff and you got to make up for the protectionist stuff. But on that topic of protectionism, kind of last topic here, fellas, right? So it does seem like there's this concept of, raw materials here at home, goods and services that are really important to like national security should be developed and made here, right? So like some stuff that comes to mind, like defense tech. So like Anduril, for example, right? I think, my understanding is all of their components or a significant majority are US made. Right. And now they built a manufacturing plant in Columbus, Ohio, and they're manufacturing here in the United States. Right. There's a lot of discussion about iPhones. Nick, you alluded to it earlier, like being made in China. So like we're all walking around with iPhones that are made in China. Like that could, in theory, I guess, stop at any time. I don't even want to know what's going to happen with Apple and Apple stock if some of these tariffs stick. Right. That could be, if it's not excluded, it could be super interesting. The semiconductor stuff in Taiwan has been a topic of conversation here for a while. And that's, I think, designing the chips, but also fabbing the chips as well, which is very hard to do. And it has huge capital expense. But then there's just like raw materials. Like I took a look at like electric batteries. That's like lithium and nickel, oil, right? We were doing fracking. We stopped doing fracking. So like it kind of, I guess so driving it home to pre-IPO stocks. I mean, I think defense tech seems to be definitely an emerging technology trend, right? In this asset class, I could probably see that accelerate. That seems like that might accelerate. I mean, Boeing, to your point, Evan, like Boeing and Lockheed and some of these other companies, maybe there's more Airbus getting sold. Airbus, correct me if I'm wrong, that's French. That's a French company,
Correct.
right? So like,
yes.
Yeah. So like, maybe there's more Airbus happening in Europe and Asia. So, that might be tough for Boeing. So maybe we got some opportunities there. And then semiconductors, there's a lot of semiconductor companies, right? Cerebras, Rock, others, right, that are kind of coming on down the pipe. I mean, NVIDIA's here as well, but everything gets fabbed in Taiwan, or for the most part, they get fabbed in Taiwan. Grok actually makes their chips in New York State, right, which is interesting. So like no tariff on Grok chips, so that's interesting. But what are your thoughts on just the protectionist opportunity on the pre-IPO stocks, Nick? Like, you think does that summarize it well? Are there other companies that you would think about in this space? Like, what do you think?
Sure. I think we are slightly buffered in some ways because they are very SaaS driven, which is helpful. Like a lot of the cost is salaries, bonuses, going right back into people and experience.
Mm-hmm.
But I think I'll just go back to some of what Evan was saying. You have so much talent in, I think you referenced Serbia and elsewhere. If we put up those barriers for international students, start with the student base to come domestically, that's actually just as impactful, I think, long term as some of these tariffs are. So yes, I mean the cost of building out these goods is going to go up no matter what, the components and things of that nature. But I think because a lot of these growth stage stocks focus on software and actual IP going into the hardware, so it's not like we're producing bricks. You're actually producing things that have so much IP built in, even if it is just hardware. So like the semiconductor industry and things like that. I do think more of the names that we focus on are a bit more protected than the pre-existing companies that are on the S&P 500 or Russell 2000, whatever it might be.
Right.
So
okay.
It's still a negative thing, but maybe less negative than what's getting hit in the public market again.
Right.
Evan, as you say that, I'm also thinking, Mother Nature must be happy about this. With less going back and forth, it's going to feel like COVID again.
Right.
Supply chain issues, but then you have deer in Central Park like walking around. Like, there's one benefit from it in the short term. Nature,
not good if you're a Flexport investor.
Yeah, Flexport. Okay, so like Flexport's going to have a tough go of it, but there's also, opportunities perhaps to innovate there too, right? Maybe they're not shipping stuff back and forth between the U.S. and other places. They got to take advantage of some of the international routes that would pop up, right, from this.
Yeah, I 100% agree. I think I wonder, the thing I think about is that if you bring some of these industries locally, and I think defense tech, Aaron, is probably the right way to think about it. Like, we're going to invest in that. It's national security. I think it's really important. And I could see a lot more dollars flowing to that, which has been historically underfunded in my opinion. So like, it's probably a good thing, but it does create a little bit of risk that, if you can't buy and or roll products, say in, Germany or Poland or some other, Western nation, you're more incentivized to try to create them yourselves. You sit there and say, well, we were funding NATO, and part of that funding it's sort of like round trip. Like, we fund NATO and then they buy American weapons, and great. Now, like, that helps our American, weapons industry. Suddenly, like, NATO's funding themselves. We're not giving them money. They now have a lot more flexibility and choice on where they can deploy those dollars. And maybe they'll want to buy Russian weapons, or, I don't know, Korean weapons or Japanese weapons. I don't know. I'm not an expert in any of that stuff, but I just think it's interesting that it's a potential negative externality that by creating, an insular market, you sort of allow other countries to have to force to innovate. And I think, one that everyone talks about is semiconductors, right? Like, if NVIDIA keeps all their IP, here's what Nick said, like, the IP is super essential. And then all of a sudden, like, well, now China is forced to create their own models because they can't use OpenAI and, they can't use Claude. And so now you have a DeepSeek moment. And then you can see the same thing happening with semiconductors. You can see the same thing happening with essential industries, robotics. I think, electronic EVs is one of them. So it's just going to be very interesting how it plays out. And it does present some opportunities locally, but it also creates a lot of global challenges.
Yeah.
And, we'll see. What question for you both? Do you think in the next 12 months, would you say that pre-IPO index that you run is going to be lower or higher on the valuations, on the P and the?
I would say lower. Yeah.
Lower.
I mean, yeah.
You're thinking it's all
I don't think it's like, to Nick's point, I don't think it's certainly the private markets lag the public markets, right? But maybe I should be more clear. Whatever happens in the public markets, I do think will trickle down into the private markets to some extent, just like it did in 2021, right? And 22. So, I think that will happen. If the market's down for the year in the public markets, I think we'll see it. It will happen in the private markets. It will probably just be, I think, to Nick's point earlier, it'd be on like a 2 to 3 month lag, and it probably won't be as severe. That's my other take, right? So if the Qs are down 20, I think private stocks would probably be down 10. That's my gut, and it would be like a quarter delayed.
I'll bet you a beer. We're positive.
Okay.
Yeah,
positive for the 12 year.
Months out.
I kind of think that way too, but I want to hear why Nick says, and I'll give you my rationale.
So to a certain extent, we're seeing so much demand for private stocks. Everyone that is waking up to that moment is really interested, right? And we're seeing so much money being pulled out of the public market. It's going to go somewhere. It's not going under people's mattresses. Gold is up massively, for the last 6 months. I think there's going to be a broader reallocation of assets, where 10 years ago, people were waking up and thinking, oh, cryptocurrency might be something. And then 5 years ago, it was. And now it truly is. It's observed as something that you can talk to your RIA, and they'll place you into one of these ETFs or one of the actual direct blockchains. I think that privates are having that moment right now, and the global reallocation is going there. There is a lot of dry, maybe quasi-wet powder that still has to come back into the market as well. And with the lack of IPOs coming to market, there's that bit of pent-up steam that I think has to be pushed to the private company. So I don't know that primary rounds are going to be like skyrocketing and there are going to be a lot of them or anything like that. But I would say from where we are today on let's say the top 50 names, or wherever you want to slice it, 10, 20, or 30, I think we'll be up 12 months time.
Well, I hope that's right. I like that. I would like that a lot. There's definitely spots though. I mean, come on. There's definitely spots though. Like if we were talking about this AI agent adoption, defense tech, right? If those things start to play out, then I mean that's like.
Well, we'll have shortfalls too, right?
Company specific, right?
Yeah. So we're going to have a bunch of companies go out of business, no doubt. We're going to have
no. I was saying those would be good things.
Yeah,
those would be good things for those companies. Yeah.
Yeah, exactly. Yeah. But for every one of those, we're going to have more that perform well as the AI apps emerge and as these AI companies, like some win, some lose.
Right.
But we're going to have more gainers there, and I'm pretty confident in that.
I agree. The thing I think about when I just looking at the index and the way thinking about the market over the last 5 years is a lot of the companies that got efficient and cut headcount, they haven't repriced yet.
Mm-hmm.
Like we didn't see a lot of
properly. That's right.
We didn't see a lot of proper up rounds or flat rounds or anything following the 2022 cliff down, right?
Mm-hmm.
And so we were sort of expecting to see that this year in 25. A lot of those companies, remember, like Affirm was like $6 a share. It's still like 30 something dollars a share right now. It's like up like 5x, 6x, 7x, something like that. So I feel like there were a lot of companies that were poised in 25 to do new rounds, and they got efficient, they got profitable or close to profitable, good unit economics, acquired new customers, and they were all doing pretty fine. And these tariffs come in and they sort of create a juggernaut from the liquidity side for all these investors who are like, well, I don't want to put it in the public markets because there's so much uncertainty. So I'm going to take my money and I'm going to think, well, I got to put it somewhere. I'll make a long-term bet, something without as much volatility, in companies that probably have great metrics now, and we're probably going to price it higher. You probably get them at a discount, but you'll still get them at a higher valuation than they were in 22 and 23. And so I think it actually presents a lot of opportunity for investors in the probably not the top 10 names, but the next 40 could all be pretty interesting. And then you have the AI, like the tailwind, where, okay, there's still a lot of efficiency to be built in there. They're leaner. They have more margin to play with. So there's a lot of opportunity, I think, if you're trying to make long-term bets and you don't want to deal with the volatility. And, I think those companies still have to reprice. Like I look at my portfolio, I think of the 10 names I hold, only 3 of them did rounds since 21. So I'm like, okay,
oh wow,
eventually they'll do one and they'll probably be up. So it'd be great.
Yeah. Well, I got to tell you, fellas, this is, look, it is what it is. It's not fun, right? These tariffs are definitely not fun, and it's a little unnerving, but I don't know. I've just been around long enough now. This is where you can actually make a lot of money.
Oh yeah.
Right. So if you're a professional investor, this is it. Like, this is what you get paid for. You got to show up, you know what I mean? And, find where the opportunities are. I just think in this asset class, there's going to be some big winners, right? So my hope is, as a buyer, right, that we're going to be able to, and, we do vintages in this kind of space, in this kind of private world, right? Like, my hope is that things kind of come back a little bit so we can get in at a good valuation point, because I don't think we're going to have any exits. So for those folks that are already in, it's paper gains going or bouncing around, right? So I think everything comes back. Like I mentioned earlier, this is a short-term thing. Whether it's a new government in 3.5 years that changes it, or it kind of rolls off and finds a settling place here in the next 12 months. Like, there's going to be a window to take advantage, and I'm like laser focused on trying to figure out what that is.
You just tell everyone, Aaron, that remember in 22 when all these companies were on 70% off sale, and then in 24 all of us were like, man, I really wish I had put money in that company when the valuation was 50% off.
Listen,
that will happen again.
You know what this reminds me of, man? This is like, and I'm going to sound like an old fuddy-duddy here, but in 2008, I was at Morgan Stanley during the financial crisis, and I remember, day after day after day of just bloodbath red, and everyone's like freaked out. Nobody's doing anything. It's like everybody's paralyzed, right? Feels kind of similar to what's going on right now. Nobody really quite knows what's going to happen. Is the Fed going to do something? Is this going to happen? Are they going to pass this tax bill that they're talking about? Like, everyone's just waiting for like the next piece of news. You know what I mean? But you looked like 12 months after, markets were back up. You know what I mean? It was like, and then now you look at the broader scale and it was like, oh, there was like a kind of a sharp V there. You know what I'm saying? So like,
you look back and like, that must have hurt. I'm like, no, we lived through it. It did.
But this is what I'm saying. It's like, it's like everyone, it's like tough as an investor, I think, to see this, but like everyone wakes up in the morning, puts their pants on and goes to work. So like, it's not going to change because we have tariffs, right? So like, we will chug on and markets will come back because people still want to retire and they want to buy a house and they want to do all these things, right? So like, life will go on and there will be a settling place. And the great thing about capitalism is this stuff will all like find a way to maximize efficiency. So like, as investors, it's like, this is where I'm like, ooh, like, this is it. This is it. There's like going to be something that comes out of this. There's like opportunities to make money. You know what I mean? Like, we can make an investment. It's like, but where to do it? You know what I mean?
Yeah,
because like, I feel like you got to be a coiled spring. You got to be a coiled spring. You like have your eye on the right thing. And then when the opportunity hits, you pop and you do it,
Yeah, I agree. And I think, there's going to be the largest wealth transfer the world has ever seen, right? Coming up right now. We've got inflation eating away at a lot of people's retirement accounts. You're going to have to act in such a way that, you're more than beating inflation.
Yeah.
You want to be really decently well diversified, well, depending on who you talk to, because anything goes now.
And accessibility is growing. Like the ability to invest in privates is just getting more accessible. right? There's more deals, there's more players, there's more platforms, there's more opportunities. And yeah, I think that's absolutely correct. Like people are going to realize that they shouldn't have all this exposure to the public markets. They should probably get diversification. They should probably invest some capital in long-term bets. That's what this is. And I think I think you're right, Aaron. Like, you got to, when there's blood in the streets, you got to take action, because this is the opportunity. This is it, or in the next 3-6 months,
soon.
It's coming soon. The capitulation is near, and it'll be a good
opportunity.
But don't
wait, you know what I mean? But don't wait until the market's up 30% and you're like, oh, I missed it. It's like, have a plan, right? Like have a plan and get, have your eye on something. And then, when the time feels like maybe things might be turning a little bit, you put some of that dry powder to work, right?
For sure.
Yeah, man, this is it. And then and then depending on how this stuff like settles in, then there might be some like really interesting like medium long-term trends that you could capitalize on, right? Kind of with the more proper rebalance. So anyway, look, this stuff's not fun. I get it. You know what I mean? No one likes this stuff, but
I've seen a lot worse. So I'm okay.
Take advantage. You know what I mean? Like take advantage. So
be patient, be smart. That's what
that's what I'm interested in.
Dollar cost
I'm interested
average.
in finding ways to take advantage of it. So
and there will be opportunities, right? Like
for
nothing
sure.
else. Yep.
For sure. Okay, let's leave it there, fellas. All right, I appreciate you guys. Thanks for